Memory has become one of the hottest trades in AI, but after a recent pullback, investors are asking, is this a buying opportunity or a sign the trade has gone too far? Joining me now is DiFazio, ETF Strategist at Roundhill Investments. Thomas, great to have you on.
Thanks, Caroline. It's great to be here. Appreciate you having me.
Well, Thomas, your Roundhill's DRAM ETF has been getting a lot of attention lately. I've been seeing it mentioned in the comment section from our viewers. Before we get into the trade and the fund, let's start bigger picture. Why has memory suddenly become such an important part of the AI story?
Yeah, well, what we've seen the AI revolution has evolved significantly just in the past couple years, and it is a byproduct of the technology itself. But AI is no longer just a chip story. It's about the whole machine. And as investors have realized, it's not just about the semiconductors. It is about memory, which has really become a constraint and bottleneck in the AI revolution. The best AI chips are going to underperform if it doesn't have enough memory to service all the requests that it's getting. And we constantly are seeing as we have the next Claude model come out, the next Chat GPT model come out, is it the queries are only getting more energy intensive, and when we add on thinking and verifying all of this information, you need more memory to satisfy those requests and to do them properly. And that's really where the enthusiasm for the trade has originated, and where this insatiable demand throughout the industry has come about.
The only issue is we've seen this really strong run in the memory trade already. We are seeing some profit taking now. Micron, SanDisk, Western Digital, names like that are all off the highs. So do you think that the memory trade has gotten ahead of itself, or do you think we're still in the early innings here? And for those investors who aren't in, do they still have a chance?
I think memory overall, and this is the Roundhill's firm view too, is that we are in a long-term structural change for the memory cycle. This isn't just a couple month story. Now, since DRAM has launched in early April, we have seen that memory stocks have been very much embraced by the overall market. And right now, it's hard to argue that when you see such eye-popping price action, it is easy to think that, wow, maybe the trade has gone ahead of itself. But we do cite a couple other important factors. The first one being that of all the largest mega caps in the world, semiconductors are among the cheapest. Samsung and SK Hynix trade at around 7 times earnings, and Micron trades at around 10 times forward earnings. That is extraordinarily cheap relative to the broader technology sector, as well as relative to broader equity markets. That's an important figure to keep in mind. It does showcase that even with extraordinary price action, you have relatively inline valuations. But the other part of it that's important to keep in mind is that, and we saw this with Micron's earnings last week as well, there are still fundamental underpinnings that are supporting this price action. This isn't just multiple expansion, all even from suppressed multiple levels. So now we're really encouraged by what we've seen so far, and Micron, Samsung, SK Hynix, and the rest of the memory trade have delivered. Um, Going forward, I think we are entering a new era of price discovery for the memory stocks. In our conversations with clients, we do get those questions about, well, is this the memory of old? And for those that are curious about the history, memory used to be very much a boom and bust industry, where you are capped by demand of device upgrade cycles. We look at Windows 95 in the mid 1990s, and then you could look at the iPhone 7 in the mid 2010s, where eventually that insatiable demand for memory was short lived, and then you saw memory prices crater as supply started to catch up. We're now in a new era where we don't believe that there is a device cap on memory demand. As AI continues to grow and be integrated into the world economy, and frankly, we think that AI is industry agnostic, it's applicable everywhere. There's only going to be a need for more memory, even if the devices get more efficient. And that's where we tend to not get too concerned about okay, perhaps we're seeing a downturn from last week's incredible price action or last week's difficult price action. Because when you look in the longer run, this is about finding a brand new baseline for memory stocks. And that is going to take some time, and that does come with volatility. And we're cognizant of that. So for the shorter term tactical traders, Caroline, I would say that, yeah, you're going to have to play, you're going to have to play a little bit more thoughtfully for now. But for those longer term investors that are looking to allocate to a portion of their portfolio, this is where we would say that it gets a little bit more difficult to start sweating the ticks and to start thinking about the longer term.
All right, quick break. One thing I've realized covering markets is that a lot of people know exactly what's happening in their portfolio, but have a much less clear picture of their overall finances. Thankfully, we have today's sponsor, Monarch. Between bank accounts, brokerage accounts, credit cards, and everything else, your financial life can end up spread across a lot of different places. What I like about Monarch is that it pulls everything into one clean dashboard, so you can see your accounts, investments, spending, recurring bills, net worth, and debt payoff progress all in one place. It also helps separate fixed expenses from more flexible spending, and AI can explain what's changing in your finances based on your actual data. This is not my actual data, so don't be judging these balances. Monarch is private and ad-free, which I appreciate. You're the customer, not the product. It syncs with more than 13,000 financial institutions and works across both web and mobile. If you'd like a clearer picture of your finances beyond just your portfolio, check out Monarch using our link below and use promo code STREET50. So this is an ETF spotlight. The fund is DRAM. I was taking a look at some of the top holdings, some international plays here: Samsung, SK Hynix. You also see Micron, SanDisk, Western Digital, Seagate. If someone already owns a broad semiconductor ETF, though, like the SMH, are they already getting memory exposure, or what are they getting with this?
It's a great question. That was actually when our product development team was hard at work at this. That was where we saw the gap. If you were holding an SMH, as a great example here, you're still getting broad semiconductor exposure. And depending on the day, you're getting mid single digit exposure to Micron, which, if that's what you're looking for, that's perfect. That being said, the SMH is not what you're looking for if you're looking to have an outsized, or excuse me, a targeted bet on memory stocks. You get Micron, but you could just own the single stock in that regard. But you are also missing two of the most important names in the memory space, which are Samsung and SK Hynix. SK Hynix actually leads the global market for high bandwidth memory share. It controls around 55 to 60% of the global market share, depending on the quarter. Now, we've also seen that in the lead up to the launch of DRAM, that the South Korea ETF, EWY, saw a significant amount of inflows. And that was because investors were looking to get exposure to SK Hynix and Samsung, but you were also getting anywhere from 45 to 50% exposure to a bunch of South Korean names that you may not necessarily look for that exposure to. So when DRAM came about, we wanted to give investors a tool to get targeted exposure to just those memory stocks. And that product set and that construction has really resonated with our investors.
But if I can buy Micron or even SK Hynix, I think next month, right, on the NASDAQ through ADRs, why pay an ETF fee at all? Why not just buy the individual names?
Yeah, no, it's a great question. It still is an access play. The ADR for SK Hynix is, I would say, welcome news for the market. Up until this point, investors have not had that ability. It'll be interesting to see how the liquidity is and how it trades. We suspect it could trade well and be well embraced by the market. But ultimately, memory is not just a U.S. story, and that's an important distinction. While the SK Hynix ADR is really important, we still are missing one for Samsung, and we do also hold names within Taiwan and other global equity markets, and that is where investors do lack certain access plays. And so that's where we believe DRAM continues to have a big value add for investors in their portfolios.
Talk to us a bit more about what role DRAM actually plays in a retail investor's portfolio. Should this be a satellite position around broader semiconductor exposure or something different?
Yeah, no, it's a great question. We've seen arguments that it can replace core technology positions. That's not where we sit, frankly. I think that is more for those investors that are really further out on the risk curve, because as you've seen, memory just trades in a very volatile fashion right now. The way we see it, we think DRAM could be a wonderful satellite position where you're looking to have targeted that's in certain pockets of either the AI bottleneck or just a certain express bet within technology that you're looking for. But it doesn't need to replace your core technology position. Those are for that it would still lack some of that. It would still lack, I would say, the diversification that a broader technology fund would have. This is one part of the AI trade, and some investors want only that, but we think that's why it still should stay as a targeted position.
I do want to ask you about risk too, because we're already seeing higher memory costs ripple through the rest of the tech sector. We certainly saw that play out with Apple saying that they have to raise prices because of higher memory prices. So does that eventually become a headwind for AI spending, or is it still bullish for memory companies?
So it could. I think the what is really interesting right now, what we've seen is through really two different charts. First one is when you look at free cash flow for the Magnificent Seven, the hyperscalers. You're seeing that has really taken a hit because of their strong CapEx spending. Meanwhile, free cash flow for the major memory players has benefited extraordinarily from it. So you're really seeing a tale of two trades. The hyperscalers are really being used as a funding trade right now for the memory stocks, and I think that's a really compelling argument that spending appears to be in place for the intermediate term, and we think that the memory stocks are going to continue to benefit from that. And we're continuing to see they are investing as well. They're doing a lot of long-term contractual agreements with their customers. Now, the really interesting part is that means there's an even smaller pool of supply that needs to be dedicated and for investors to get exposure to and for companies to get that memory allocation to. So these memory names continue to grow their production because they have to, and they need to be able to satisfy the demand, which they're seeing in place till at least 2030, and it could go beyond that.
6 months from now, what do you think investors will wish they had understood about the memory trade today?
I think that investors are going to wish that they understood more about where the memory sector had been, so that they can have a more informed understanding of where it could possibly be going. I'm a student of history, and my optimism from the memory trade came from looking back and where memory had previously been and understanding what were those drivers that changed the cycles previously, and then are those drivers still in place today? There's an argument to be made that memory cost rising is a big impact right now, but I think if you continue to use history as your guide, you can then start to have a thoughtful approach on where the trade could be going.
Okay, before we let you go, we like to do a rapid fire round of this or that, quick questions, quick answers. We don't always do it for ETF Spotlight, but I wanted to do it with you, a memory trade edition. Are you ready?
Let's do it.
Memory trade, early, middle, or late innings?
Early.
Recent pullback, buying opportunity or warning sign?
Buying opportunity.
Memory, structural or cyclical?
Structural.
AI hardware or AI software from here?
Hardware.
Biggest risk, supply catches up or AI demand slows?
Supply catches up.
More upside over the next 12 months, Magnificent Seven or memory plays?
Oh, that's a good one. I'm gonna go Mag 7.
One AI theme you'll be watching most closely over the next year that's not memory.
I'm very interested in the photonics and optics stocks.
Give us a few names we should be watching.
Lumentum is a big one for me within that space. It's been a winner in this tape, but I think it's another part of the AI bottleneck that could be a really compelling opportunity for investors.
Okay, and because I know Roundhill has a whole bunch of ETFs, not just around memory, but throughout all of tech, if you could only own one AI theme for the next 5 years, which would it be?
I would stay with memory.
Okay, we'll leave it there. Thomas DiFazio, ETF Strategist, Roundhill Investments. Thank you so much for playing along and for your insights. We really appreciate it.
Thanks, Caroline. It was a pleasure to be here.
If you enjoyed this ETF Spotlight, check out our full conversation with Joe Grogan. He lays out how to diversify beyond U.S. stocks, in particular European defense stocks.